Good afternoon, and thank you for joining today's event. My name is Leah Biard. I'm a Director of CMHC Operations with CMLS Financial, as well as Chair of the MIABC Speakers Committee. Once again, thank you for your continued support of the MIABC by attending today's webinar. Your continued health and safety has always been paramount to our decision-making, and as a result, I'm sad to announce we will not be hosting the MIABC 2022 Charity Golf Tournament. With the emergence of the COVID-19 Omicron variant, combined with the lead time to plan the June event, we felt it would not be prudent to commit our members, sponsors, and volunteers to the networking golf event. Even though we, like you, were very much looking forward to the event, we will hold tight until greater certainty emerges, and we thank you again for your patience. On a more positive note, as some of you may be aware, based on your interactions with the MIABC, Tim Beckmann has joined the association in the role of Executive Coordinator. He's replacing Michelle Holst, who we wish great success in her future endeavors. If you get a chance to speak with Tim, please extend a warm welcome. Lastly, I'm very excited that the MIABC will be hosting a webinar on March 8th with guests and themes aligned with International Women's Day. This event will go live on our website shortly, so stay tuned. Today's sponsor, BDC, is honored to be associated with this event, which features their long-time clients. BDC is British Columbia's largest professional practice specializing in services to construction lenders. Presently, they are managing a loan portfolio in excess of $8 billion. BDC looks forward to continuing to provide high caliber services to MIABC members in the year ahead. They foresee a challenging 2022 as supply chain issues and labor shortages continue to dominate. They offer 3 words of advice to help in this environment: contingency, contingency, contingency. Thank you, BDC, for your support of today's event. Now on with the show. It's my pleasure to introduce today's moderator, Derek Townsend. I sense that our audience has already worked with Derek in some capacity, so I thought instead of listing off his entire bio, it would be more fun if I covered off a couple points that you may not already know. Fun fact, and Derek, you can cut in here if I'm wrong, you played for 5 years on the Thunderbird football team and have been ranked 35th on the top 100 list, and also named into the inaugural UBC Football Hall of Fame. You then joined the Canadian Rugby Sevens team and played in the World Rugby Classic for 6 years straight. So not only was Derek the youngest vice president at his firm in his firm's history, in 2018, he became a principal and an owner. So with that, I'll pass the baton over to Derek and let him make the introductions of the remainder of the panel.
Thank you very much, Leah. It's a pleasure to be here, and I'm looking forward to today's discussions. I should have asked Mike, Matt, and Garth for some fun facts, but I think we'll just keep it to their bio. So Mike Sagert is responsible for the execution of the CMHC Commercial Business Plan, which spans origination, securitization, capital markets activities, and servicing. He has been with CMLS for just over 3 years and was previously with CMHC for 11. Although CMLS provides financing in the conventional lending space, Mike's activities are focused on CMHC insured financing. Matt Muir is the Director of Commercial Real Estate at Coast Capital Savings and leads a 10-person team at the downtown Vancouver office. Graduate of UBC Sauder School of Business, Matt spent time working in appraisal, brokerage, and land acquisitions before moving into banking and commercial lending with TD Bank and now Coast Capital. Coming in with the longest tenure and obviously most knowledge and experience is Garth. He has been active in the Vancouver real estate market since I was 1 year old, to give you a little context. He is the VP and regional head of the HSBC Real Estate Group, with his hands in land financing, pre-development and construction financing, and assisting acquisitions across all asset classes, including hospitality and seniors facilities. So in this market today, it is extremely busy, all different areas, tons of projects, lots of activity all over the province with lenders, brokers, lawyers, appraisers, all slammed. One good thing in this market is that there seems to be a lot of liquidity amongst lenders. City Fund, we are seeing this through extremely competitive terms from many different lenders in all different product types and in many different markets. So to get started, I ask Matt, how's the demand at Coast? How's the competition? Are you having a harder time getting deals? Are you filling your budgets? Do you have more money to keep growing? How is it looking over there?
Sure. Yeah. So I'll start with 2021 for us was a record year on the construction side. We did more business than we've ever done. So we've been trying to keep up with what's out there, and there is competition, but very much demand is exceeding it. Our construction book continues to be busy into 2022. Our pipeline's strong. We also do term lending as well, and term lending's been busy as well. I think anytime you have rates moving, you're going to see a lot of activity with refinancings. You're also seeing so much extra equity in the market that with the increasing rates, compressed cap rates, just increased values overall. There's a lot of equity and people are trying to realize on. So we've been busy on both fronts. Construction's been, typically over, my years of lending, construction's been very geared towards pre-sold residential strata projects. The last 12, 24 months, we've seen a real shift where we're not, we've always been open for all asset classes, but we're truly seeing a big shift to industrial, whether that's strata or lease, office, same story, strata, lease. So we've been able to diversify across product types, and I'm very happy to do that. So it's been a good last 12 months for sure.
So being so busy, how quick are you getting approvals? Are you working with
Derek, our program, we tend to be, we try to pride ourselves on being a bit creative and being able to do some things a bit out of the box, but sometimes that comes with a little bit of upfront work. So we tend to go to our risk group at LOI stage, before issuing a term sheet. So there might be a week upfront, whereas instead of issuing next day, we might be a week to get that upfront, but provide some certainty for our clients or for brokers, and then following that, we might be another week. It gets our approval process moving quicker, so maybe another week for approval, and a couple of weeks for security. So 1 month start to finish is generally not an issue for us, and it ebbs and flows. And
well, with a 10-person team, you can probably handle a fair bit, which is good. Garth, you mentioned just as we were waiting to hop on this call that the early half of the year of 2021 was a little slow, but you finished with on a roll. Are you still busy? What are you guys seeing out there? Are you filling through your budgets, and are you expecting that to continue for the start of this year?
I'd say certainly for the foreseeable future. The tail end of last year was incredibly strong. I would say we largely overshot any expectation that we had going into the year. It's hard to say how it'll run for the entirety of 22, but I would say based on what we're seeing right now, there's a ton of capital across all lines. It ebbs and flows. Industrial is incredibly strong. Market housing, be it for rent or for consumption, is incredibly strong. Less available to retail and office. But, we went into COVID, I would say, in a pretty strong position across all of the asset classes. And as we work through COVID, and we're certainly not through it yet, I think we're pretty well positioned, certainly within the major markets, Vancouver, Toronto, Montreal. Calgary, I think, has some real sweet spots, but, we're certainly strong here. And I'd expect the balance of the year, there's a lot of projects, prospective developments that are sitting on the shelf. As the market absorbs those, there's going to be more coming. And I think that'll bode well for all of us as the balance of the year unfolds.
Thank you. Mike, you have a little different view, as not only are you with CMLS working, with the lender, but you're also dealing with their investors, sources of capital. What are you hearing from them? Like, how is it for them? Is there lots of capital, and are you finding more and more investors? What's going on in your world?
Yeah, it's busy. The demand for capital on both sides is as high as I've seen it. Like, I think it's really interesting in the last 6 to 8 months. There's been a theory of the amount of liquidity in the system and whether or not that would ease, and we're just not seeing any signs of that. So on the investor side, there's still an insatiable demand for capital, and on the borrower side, there's still a lot of demand for that capital. So we're as busy as we've been. Much like Matt and Garth, 2021 was a record year for us on the insured side, and like the term side and the construction side. And 2022 is shaping up for another record year. Our construction pipeline is as strong as it's been. Big catalyst has been the national housing strategy. Definitely a big player. And when the federal government is putting $70 plus billion of stimulus into multifamily housing, it's an easy space to have a record year after year in.
Yeah, I don't know how many broker year-end reports came out that everyone said they had their a record year. It's busy across the board, which is great. So, with it being busy, with supply chain issues, we're seeing hard costs skyrocketing, moving up very, very quickly. But then we also have, mortgage qualifications getting tough, stress tests for personal mortgages on the interest rate. And so, as Garth and Matt and Mike as well, but I'll stick to Garth and Matt on this. Between hard cost increases and mortgage qualifications, and coupled with increasing prices, are any of those keeping you up at night? Garth?
No, not yet. I would say, we're certainly mindful of it. The mortgage qualification part of it, I think, is going to be more of a longer term story. I think there's still such an undersupplied element, in the broader market from those people that are buying homes, that I think that becomes a bit of a longer term story. The other part of that is rates are still at historically low levels. They've popped materially, but they're still at incredibly low levels by any metric. I think on the other side of the equation, with pressure on margins, supply chain, hard costs, soft costs, across the board, so far, the top line has alleviated that. We've seen a good recovery in price point in the market to absorb price point. I think when that becomes an issue and when that margin gets to be too narrow, and that'll be developer driven as compared to the consumer. I think that's probably more immediate, because we're seeing it, the implications of that, often and repeatedly. Developers are getting a lot more astute at how they are dealing with this, but it's going to become more of an issue. And I think that'll be more of a story as 22 unfolds. I think the mortgage qualification process and higher rates, my sense is that's going to be more 23, 24 and beyond.
Awesome. Thank you. Matt, do you have anything to add?
Yeah, no, I think Garth's bang on. Inevitably interest rate increases and mortgage qualification has an effect on demand, but there's so many other factors, and you're going to have probably a massive increase in immigration over the next year or two. COVID kind of put a temper on it, but the demand's there. So, between that and maybe some work from home, people needing a little more space, some change of what they getting into something bigger. Overall, I think that demand is just going to continue to press prices up, and on the supply side, we just can't keep up. I think our developer clients are doing everything they can to get approvals through, but municipalities are still fraught with delays, and Our geography alone, creates some issues on that side. So, all said and done, interest rates will have an impact, but I think your demand's going to outstrip your supply and for the next few years.
So, I mean, I've noticed this. I'm not sure if you guys have as well, but in Vancouver, you haven't seen quite the price uptick that you have in the suburbs. I mean, Metro Town now has projects at $1,350, $1,400 a square foot. Maple Ridge is skyrocketing. Like all these other suburbs are, there's huge price escalation. Vancouver proper hasn't necessarily seen all of that, other than maybe the duplex side, but not on the multifamily nearly as much. And my personal thoughts would be, you don't quite have the value of living downtown. There's no events. There's you're working from home. And so as things change and as we move forward and potentially this afternoon we're going to have an announcement as to whether BC is going to start relaxing our restrictions. Alberta's done it or planned, and Saskatchewan, all these other provinces across the country have. And I mean, even just this morning, the federal government mentioned that we no longer need PCR tests for fully vaccinated Canadians coming back. So things are getting into the new normal, right? So, I mean, do you guys see that these suburb communities are going to continue to just uptick and potentially Vancouver comes back, or is the value going to come back to the city, and we're going to start to see the housing market in Vancouver catch up to where the suburbs have gone over the last 24 months? Garth?
I've been fielding questions about the death of downtown, the death of city living for the last 18, 24 months, and I don't think it's going to happen, frankly. I think there's a lot of compelling reasons for people to move to the suburbs, most of which you touched on, Derek. One that you didn't touch on, though, is just affordability. If you're at $800 a foot in Surrey, it's a lot more appealing a proposition for the homeowner, even if it's a condo, than if you're at $1,400 a foot in Burnaby, let alone $1,800 or $2,000 a foot downtown. And so I think in real dollar terms, like to like, it becomes a real factor. But cities are going to come back. The energy level will come back. The need to live, close to work may not. That part I think could change. I think we are going to see some real changes going forward. But I don't think it's the death of the city by any stretch. I think there's still a lot of things that appeal to, sort of an urban-centric lifestyle, particularly for the new immigrant, particularly for people that happen to work downtown. That part I think will come back. I don't know exactly when. We've started to see it come back in sorts of late, but I do think it will lag a little bit, but it absolutely comes back.
Mm-hmm. Matt?
Yeah, I mean, along the same lines, I think between transit and work from home, the suburbs and more affordability, the suburban markets have seen a huge uptick in demand. And if you want to take your your investing decisions from a lender, I think downtown's undervalued. I think it's really it's lagging, but it's going to come back at a faster pace. There's real good reasons during the pandemic why suburban markets have increased, but just a little bit of life in downtown, and I think people are going to come back. And you see it with our clients, whether they're buying office space or building office space close to the downtown core or Mount Pleasant. There's going to be a lot of jobs continue to be needed in that core, and people wanting to live close to work and be part of that real urban lifestyle.
Yeah, there's a lot of office coming to the downtown market, and there's zero relaxation in lease rates. They are high, and so it is expected that people will come back, and so maybe now's the time to buy in Vancouver if you want to listen to Matt. So changing gears a little bit, CMHC debt is a big part of the market, especially with rental supply, actually being somewhat meaningful over the last few years and gaining momentum. CMHC has some great product they're coming out with. They've had a good product in the past that is now changing. But, over my 10 years at City Fund, the demand keeps increasing, and especially over the last 3 to 4 years. New lenders have been entering the market, adding to their or adding this financing arm to complement their existing business, and existing lenders are finding new investors and increasing their capital sources and portfolio size. So Mike, you already touched on this a little bit, but let's dive a little bit more into that CMHC side of this stuff. You mentioned there's tons of sources of capital, but the demand is high. Is this going to continue? Like, it just seems that it's CMHC, the government's going to be insuring, billions and billions of dollars as the market just continues to increase. Is your demand being filled? All your pools, is there, are you turning investors away? What's going on the CMHC side of things?
It's funny. The discussion on the last question, I think, really ties in well here. And I think one of the best things about being Canadian is how welcoming we are and how diverse we are. And when I look at those immigration forecasts, I don't know what the number is, 420,000 new immigrants every year. And I think about the question of, urban versus suburban, I think it has to be both, quite frankly. And CMHC's certainly playing a big role in that. They're stepping up with some new products like the MLI Select, which is just about to launch. But, I don't think there's an end to the runway on the horizon. I think we need to build more rental. People need places to live, and there's another layer on top of this as well of the ESG lens, right? Like we're starting to see those investors on the other end not only continue to demand insured debt, but they're looking for social responsibility. They're looking for governance, and they're looking for green, which really hasn't happened in the past. So I think this conversation will continue to evolve, but I don't see CMHC stepping back, or the investor demand stepping back anytime soon.
Well, I guess with bonds creeping up, investors might even pull in a few more, given the fact that they can get a reasonable return. 2020, when they're buying bond pools at 1.7% for 10 years, there's cheap as chips. So do you expect that with expected interest rate increases that it could even be more? So the rental market could be well supported for years to come.
Yep, I think you nailed it. That definition of reasonable return has certainly moved around in the last few years with record low yields. But I think for the time being, that risk return trade-off for an investor who's buying a CMHC insured mortgage is pretty attractive, and I just don't see an end on the horizon.
Nice, thanks. So this is a good segue into interest rates. Everyone is talking about interest rates coming, or interest rate hikes coming. We're expected to see the first Bank of Canada overnight increase in March. Bond yields have skyrocketed over the last 4 months. Tons of volatility, a lot of up, a little bit of down, and then up again. Bond rates will, they're an investment vehicle, and they go with the open market and fluctuate daily. Mike, but do you expect to see these increases to continue? Do you think that if the Bank of Canada announces the overnight increase that everyone's expecting in March, that the bonds have already sort of accounted for that? Every day I come into the office, it seems like another 8 or 10 beeps are up. Like, what are your expectations for bond rates over the next 6, 12, 24 months?
It's a really good question. I stopped trying to forecast interest rates a long time ago, but I think the trend's clear. We're definitely in a rising rate environment. I think the real question is, does this continue? Do we rise, plateau, and come back down, or do we continue to rise? And I think depending on what happens, that could have a real impact on investor appetite with yields. But I think for now, when we're looking at this, it's a little bit more concentrated in the construction market on our side. Whether or not these projects can be built with rising costs on one side and possible rising interest rates on the other side of it. So there's a good, strong non-answer for you, but we'll see what happens.
That's good. No, thank you for that. So then Garth and Matt, you guys, I mean, do a ton of construction, prime-based lending, which is, correlated with the overnight rate. So, March expecting an increase. There's used to be talks of, 1 to 3 bumps. Now it's 4 to 6. What are the magnitudes of these bumps? What do you guys, what's your expectations for the overnight rate and, ultimately prime rate over this next, near to long-term future? Garth?
I think they're going up. I would share the previous view. I think they're absolutely going up. When I got into the business, as you were apt to say, you were 1 year old, rates were in the teens. So when I look at rates today, I'm maybe a little more jaded than the rest of us, but I think rates do go up. If they went up 100 bips over the next 12 months, it wouldn't surprise me. I think at that level, then I think your consumer starts to feel it. I'm not sure if the developers will feel it. The financing costs, aren't going to move the needle dramatically. Obviously I have an interest to say that, but I don't think the financing costs on a development program are going to change, the economics of a project dramatically. A lack of consumer demand may. But again, I think we're pretty well equipped. And I think the market, as rates go up, they're not going up forever. And where they come back down to, I think, we're still coming off of what I would argue are historically below average rates. So I suspect as we go up, they come back at some point and we plateau at maybe something more in line. But the market will adapt. It'll adapt as they go down. It'll adapt as they go up. And it's rarely linear. But I think for the rest of this year, it's safe to assume rates are going to continue to creep up. Even the guys that say they know where rates are going don't really know. I think, frankly, you have to build enough resiliency into your models, because rates could change markedly. We don't do CMHC a lot, but they could change dramatically from when you start construction to when you're complete, right? Everything we're doing is taking longer nowadays. So I think it has a role, but I don't think it's going to, be the death knell of the business by any stretch.
That's good. I don't mind 1%. I mean, I think there's potential to go even more. But Matt, what do you think?
Yeah, I mean, I think Garth's right. I mean, we're if we don't see a 1 point increase over the next 12 months, I'd be shocked. And from our business point of view, it's prime-based lending, and so it goes up. And I don't think Garth's right. I mean, I don't think you're gonna have a big change to the budget. I mean, we're talking, let's say it's prime 1. So we're adding an extra point on a 2-year loan. So that's drawn up over the course of the loan, right? So it may be a 50 or 60% balance through the course of the loan. So it's not, it's not project changing, and it is all-time lows, and it'll, I don't think the developers forecasted in, and I don't think there'll be any shock there. On the term side, I think you're right. I think the bonds have hopefully built a lot of that in. I mean, who knows where they're going to go, but we continue to stick with kind of the same spreads that we've had over the last few years, and we'll continue to operate that way.
All right. So interest rates are going up. That's good. Thank you, gentlemen. With interest rates going up, obviously income deals. In our market, we have low cap rates, and so our limitations on lending, the lesser of a loan-to-value threshold or a debt service constrained loan amount. In our low cap rate environment, we never hit loan-to-value limitations. It's always restricted by debt service. When you do a rental construction loan, you're looking at, okay, well, what's that term loan at the end of the day? And that's what justifies your construction financing. With interest rate expectations to increase, that's going to obviously lower the loan amount. And, a 25 basis point swing in interest rate can be a 10% difference in loan amount. It can be quite meaningful. So, with that, we have supply of new rental products being built by all types of developers, small guys, mid-tier, big guys. the big guys are fine. They have deep pockets. What is it, Mike? Do you think this is going to change the supply of rental, or are you going to just see a lot more people selling a project because now maybe they potentially don't have the equity to inject in order to complete these projects, these rental projects, if they are the smaller or on the smaller size of mid-size developers?
It's an interesting question. I'll just add to that. There is the dynamic of the new MLI Select product, which is just about to be launched March 7th. And, in that space, if you're building green, climate compatible, or affordable, in theory, you're at a 95% loan to cost. And some of those smaller developers, maybe mid-tier developers, that could become, a real issue. So, I guess I don't know what the response is. Like Garth mentioned, the market will adapt and we'll likely see opportunities come out of it. But, the mixture of everything that goes into it, like I mentioned, rising costs, rising interest rates, incentive for higher loan to values. I think there certainly is some opportunity here for something like you described to possibly happen. So I could see a scenario where maybe those smaller mid-tier developers, if they started to run into cash flow issues, that maybe there would be a new area of the market that evolves.
95% loan to cost is one of the limitations, but you're forgetting that Vancouver land is 50% of the budget. So
right.
It's quite challenging sometimes to hit that 95% loan to cost amount, but 50-year amortizations and a little more relaxed underwriting policies on this new program will help. I think it's coming at the right time, this new CMHC MLI Select program, given that interest rates are going up. So that is going to be huge. My personal thoughts on it, I think March 7th applications open up. We have a number going in. You talk to everyone, they have a number, and I expect I would think about $1.5 billion of finance of applications are submitted on one day. Like, I think it's going to be large. I would imagine, Mike, your group's getting completely ready to submit a ton as well.
Yeah, we're ready to launch with some new product and some existing, construction that's pivoted over from the old product into the new one. So, we should hit the start line running for sure.
Yeah. Now, just how does CMHC deal with that massive application? Turning that around is going to be tough, but.
Yep.
So we touched on a little bit earlier. We have Bonnie Henry, Dr. Henry, announcing hopefully relaxations to the COVID restrictions. Provinces are also doing that already. Vaccine passports are being removed. Economic activity should, pick up at least somewhat. Do you guys expect that these relaxations or the changes to the new normal are going to have any impact on the market, or are we just continually going in the same trajectory we're heading right now? Garth?
I think, the relaxations will lead to, what will become a new normal. I don't know what that is, frankly. I think, we're all going to probably work somewhat differently. We may live somewhat differently. Shop, travel differently, what have you. So, I think the relaxations are probably good because we're going to have to learn to live with COVID. I don't see a route where we eliminate it. So we're going to have to learn how to live with it. And, how we lived with it 18 months ago is going to be different than how we live with it 18 months from now. So again, I think it's going to be fairly fluid. Honestly, I think we're all, or I shouldn't say all, I was very pleasantly surprised with how we stick handled through the last 18 months as an industry, as a market, you name it. We honestly got through this pretty unscathed. Easy to say that, with the benefit of hindsight, but I think it's been amazingly resilient as a whole. So whether or not we're going to be going as strong going forward from here, I hesitate to think we will. I think there will be some adapting and some adjustments as we go forward. But I do think as we get to, what is the new normal, and again, I don't know what that looks like, it's going to serve us well. I think Vancouver, Canada as a whole, comes through this incredibly well. You know, a lot of jurisdictions can't say that, but I think we've come through it incredibly well. I think you throw immigration, proximity to the States, what have you. I think, honestly, the next 5-10 years shape up strongly for us.
Good to hear. We'll still be busy for a while then. Mike mentioned that earlier, is that, you know, immigration, you know, we have big targets for the next little bit here. We're going to have lots of demand, and Vancouver sees a large portion of that immigration. So I agree. Matt, what do you think? How do you think we're going to fare with, you know, the new normal coming, hopefully sort of us maturing into that, and, you know, with COVID restrictions being relaxed?
Yeah, I mean, I think people's confidence in those restrictions relaxing and staying relaxed will play a big part in it. You know, I think most people are going to be confident that that's the direction we're going, and confidence results in probably more investment and more certainty in people's you know, day to day, as well as, you know, immigration is going to increase. I think you're going to see a big uptick. I mean, it's not really our market necessarily, but those tertiary markets or those recreational markets, you know, whether it be Whistler or you know, Sunshine Coast, I think you're going to see a big uptick in demand and investment as well. And you know, it speaks to confidence. And, you know, Whistler's been increasing in volumes and passes and all these other things while restrictions have been in place. So, you know, if you take that as a small kind of insight into the general, you know, the larger market, I think, you know, U.S. investment, overseas investment is gonna take an uptick when restrictions are relaxed. And I think Garth made a great point. You know, I think investor you know, sentiment of how we've handled it will give people confidence to invest here, and you know, it only comes with more demand and higher pricing. So
yeah, Mike, you're in Alberta. You know, you guys are. How's it looking over there? I mean, you guys have already announced they're coming off. I think it's already effective as of yesterday or something.
Yes.
What's going on in Alberta? You expect things to continue? I mean, obviously much different markets than here.
Yeah, very different markets. You know, I think that immigration piece is interesting. We do certainly see our share of the pie for new immigrants, and, you know, the office environment here in Calgary is interesting as well, with, you know, the almost competing priorities of, you know, the green movement and moving away from carbon intensive activities and fossil fuels, while at the same time, you know, trying to get there. And, you know, and I think $95 oil helps, but, you know, the question is, you know, long term, what does that look like? So I think of any market that's in transition, I can, you know, look at my backyard and say, you know, we've got to define and build our own future here.
Thank you. So, you know, a couple things to maybe get your chance to get some business out of this thing. You know, as you guys know, the lending market is fluid. It changes. Garth, you almost touched on it and said you're open for everything. But, you know, depending on what you're getting, you're seeing sometimes you get too much construction, too much wood frame versus concrete, too much term debt or not enough term debt, and you have to go after and find some business. So I'll ask, like, what are you seeing, Garth? What are you looking for? What's HSBC most competitive at right now, and what are you looking to fill your boots with?
Well, I think we've always been fairly selective, Derek. I mean, I think the last credit crisis in 08 and 09, you know, we certainly rejigged our approach to, you know, how we did business. You know, moving from a try to do be all things to all people to taking a much more selective approach. So, I mean, we're somewhat, I won't say totally asset class agnostic, but we typically have focused over the last decade plus on trying to build really good relationships with top tier clients. You know, we go into a center, whether it's here, Calgary, Toronto, Montreal, and really identify who are best in class and try to build our business around that. So filling our boots is you know, maybe the wrong, not quite the way we'd characterize it. It's really trying to start a relationship, build on it, grow it, you know, and 10 years later look back and say, you know, it's been really successful, it's been mutually beneficial, etc. You know, I think, you know, hospitality is going to probably be the biggest challenge on a go forward, maybe followed a little bit by retail. although I think they're both coming back, but I think it's a little bit slower for the two of them. Industrial, we touched on, rental res, res for home ownership. Those areas I think continue to be very strong. I think, I can't remember who mentioned it, but I think some of the tertiary markets, Victoria, Kamloops, Kelowna, Vernon, Sunshine Coast, Whistler, I think are going to continue to see some, flows that will move the needle for those markets. I think they're going to be very strong going forward. But I really think, the GVRD is going to be well positioned as we go forward. And I think we can share in that. A big chunk of our book is construction, a big chunk of it's residential. It's kind of a cross section, a reflection of what the broader market is here.
Yeah, and well, I mean, if you're going into those markets with, construction costs increasing and going after the top tier developers, you'll fill your boots anyway. I mean, the deals are so large now, right? Like you just can't. We come across so many 9-figure deals, loans that are, 100 million, 200 million, 300 million, which 10 years ago there was one or two around. So, Garth, do you? I guess you probably aren't doing many of those on your own. You're probably working with other lenders and working together. Do you think there's going to be an issue with deal size and the availability to fill that, given that Canada doesn't really have a massive lending market relative to the US, right? You go to New York and you have 500 different lenders that can do 9-digit loans, and you go to Canada and you have 4, unless you want to syndicate. Do you think deal size is going to pose a problem in the future?
I do. I think the deals have gotten larger. The deals proportionally have gotten larger than the bank's balance sheets. So I think, 10 years ago, we would have done the occasional syndication. It was a big deal, quote unquote, 150 million, and there was 2 or 3 of us participating. Nowadays, I think our largest syndication was just north of 700 million. The deals are getting bigger. They're getting more complicated. Having said that, all of the lenders are much more comfortable than they were, a decade ago in participating in these club deals / syndications than they were before. And they're, on the whole, are writing bigger tickets. But I absolutely do worry about, how deep is our debt market. I think there's tons of liquidity. There's, across all segments, mezz, equity, debt financing. But the deals are getting large enough where, you start to see, individual hold levels start to tap out. And I think that is a concern. So I don't know when when we hit the limit, but the sky's not it. And I think at some point we're going to have to continue to manage this. I think last tally we did, we're participating in about 115 syndications across the country, and we lead about 85 of them. So that keeps our guys our guys dedicated to this space very busy. But it is space that we've all become a lot more adept at, whether it's, HSBC and, one of the big 5. We've got some, international lenders that are somewhat active. But, we've all learned how to partner, and it's become, the market's dictated that.
Mm-hmm. That's they're huge, and I don't see that changing. Mike, you are obviously dealing with some of these sources of capital. Are the guys you're talking to, are they able to write these single loan large checks, or can they do that, or what are you seeing from your side of the investor market?
Yeah, it's much like Garth mentioned, if we rewind the clock, when we hit those larger ticket loan sizes, even 3 to 5 years ago, there would have been limits, and investors would have shied away. But there's definitely been an evolution of some new tools in the market that have allowed the consumers of those of the capital to choke down those larger loans. So whether it's a syndicate on the construction side or just being really creative and securitizing the term debt, we've got the tools for it now. So I think it's just the opposite. I don't see issues on the horizon with choking down the bigger loan sizes. And maybe to dive a little bit deeper into that, I think it's really important to give CMHC and the folks around that space some credit in providing some incentives for building affordable housing. And in the future, I think it's pretty reasonable to think that some incentives may come for building green and climate compatibility, and that helps the investors on the other end. So if we're doing a good job of aligning the interests of what Canadians need, what the social fabric of our company needs, and the investors can choke it down, I think that's really good news, and it seems like we're all winning out of it.
That's good. Yeah, the market's busy, and I think they're just getting bigger. I mean, you can't build anything in Vancouver for less than 20 million now, it seems, and that used to be a relatively good sized loan. Matt, Coast Capital recently became a bank relative to a credit union, so you guys have had to change a little bit, different restrictions or different requirements. And I know there's sometimes client limits. And obviously with these big deals, you got to split it up. What do you see with these big loans? And I know you guys do a lot of club deals, as Garth puts it, but what are your thoughts on where deal size is going and how it's going to be handled?
Yeah, so you're right. I mean, we're federally regulated. We're still very much a credit union, but we have the ability to lend kind of across the country, and have the same regulator that HSBC would have. We continue to participate on really strong deals across the country and be a part of that syndicate. But maybe not our focus in terms of what we're doing or going forward, what we're looking at. We tend to, we have things we need to tick, whether it be experience, net worth, liquidity, but happy to deal in that wood frame space where maybe there's a little more spec exposure. We actually have a great builder finance program. We have a group that does spec lending from anything from one single family home to a small infill development. So we're doing a lot more of that lending. And I think a focus on spec. We're talking a bit about rising costs and revenues. Is our bread and butter for years. Everyone's been kind of spoiled with pre-sold deals because the market's so strong. I think you're going to see a little bit of clients getting away from that, not because the market can't support the pre-sales, but because they don't want to lock in their revenues in the face of rising costs. So we'll still have our pre-sale targets on large deals, but the idea of blowing through everything in a weekend maybe isn't even ideal, even if you can do it from a borrower's perspective. And as lenders, I think we need to get a little more comfortable with what that looks like. And there's different levers we can pull on to accommodate that, right? Whether it's a lower loan to cost or dealing with certain borrowers, but we're doing spec loans on 3, 4, 5 single family homes, and that's the market. These guys, their margins are quite thin and they don't want to lock their revenues in while they're building. So
yeah, I don't think there's any issue selling any product right now. It's just if some variable comes in and changes anything. But, I agree with all your guys' sentiment throughout the call. The market's strong. There's lots of financing options. There's no liquidity limitations. There's so many deals getting done, moving forward, progressing to construction, and so much action in the sales, apartment buildings, industrial spaces. There's just so much activity in every market. So what I sort of gathered from our conversation is that things are strong, and we don't have any hesitation to keep lending. Is that consistent with all your groups like Treasury? Are there any hesitations? Is there any reservations your groups are having these days for the outlook? Like, be cautious here, we're not doing that, or anything like that. Is there any negativity coming out of your group, or is it all like, let's move forward? Mike?
Yeah, I think there's spots where we're more cautious than others. I think if you look at one end of the spectrum being multifamily or multifamily insured and industrial, I think on the other end of that spectrum, we would see something like, hotel, hospitality, to traditional retail. I wouldn't say it's a red light, but maybe we're not as competitive in that space, and maybe there's larger risk appetites for that product than we have, but I don't think we're shut off for anything.
Yeah, no, it's I mean, hospitality is definitely one that got beat up so bad throughout the pandemic. And I mean, but even in Vancouver, we haven't had a new hotel built. I mean, or we have it, the supply's been so minimal that and we have such a high occupancy rate of hotels that, when it does open up, things will be full again anyway. Garth, you mentioned a little bit about hospitality. Were there any other areas or negative sentiment, HSBC or Treasury or credit are thinking about over the next little bit?
No, I mean, I think at the end of the day, we're all lenders. We're probably all cautious, somewhat cautious by nature. But as far as asset classes, I don't want to say we'd do anything, but, we would do a lot for the right name, the right people, the right relationship. And whether that's an asset class or a location that maybe is not, entirely in our wheelhouse. But I mean, there's really, it's easy enough to say this 2 years into COVID. There's really nothing I see going forward, that is keeping us up at night dramatically. I think we're going to continue to follow our program, focus on clients that we want to grow with a diverse portfolio. And it's not about eliminating risk, and it's not about going into a deal blindly. It's more about trying to mitigate the risk. And if you're going to do it, then do it prudently and price it appropriately. Mm-hmm. Notwithstanding, everybody's desire to have the cheapest possible flow of capital, I think part of my role is to prudently deploy it and to price it accordingly. And there's deals that are very good real estate transactions with good proponents, but that I just can't make sense of from a pricing perspective. And there's nothing wrong with that, right? I mean, that's what makes a market. And so I think, is there anything that I can point to, as be it an asset class or a segment that is of real concern? No, I just think coming out of it for some of them is just going to take time, and it'll be a bit slower.
Yeah. Matt, anything you're worried about, or what they're telling you to stay away from?
Yeah, no, I don't think we have any hard red flags, but I think the expectation of contingency is, or at least it's under the microscope. Maybe we would have expected 5%, and that's fine, and maybe we would have gotten away with 3% for a good client. Now we're seeing or encouraging, more like 10%. It provides everybody some comfort, and maybe and we're talking on hard costs. On the asset class side, let's put residential and industrial in one bucket, and retail and office in a different one. It doesn't mean we're not lending against it, but I think Garth's point, we're pricing to risk, and we're there's no asset class we won't look at, but we're structuring our deals to accommodate that risk, and pricing our deals as well.
Wonderful. So with the digital world upon us, something that I can't keep up with, I now I'm lost. It seems and feels like cryptocurrencies, stuff like that are real, and they're sticking around, and there's something that it's going to grow. Do you see that entering our market? I mean, some countries have adopted it and brought it in and accepted it. So is that going to ever enter into real estate? Do you see that in any way, Matt?
I'm gonna say this is probably outside my pay grade. Like, it's we're a conservative bank, and I don't see us. I don't think Coast is going to be breaking any ground on Bitcoin anytime soon.
And well, what about like developers? Accepting payment or whatnot? Things like that. Something like Elon Musk accepts Bitcoin to buy a Tesla. Like, how does that work? Or are we too far away? Or, I mean, personally, I don't even really get it. So, or maybe we don't even understand it.
Yeah, I mean, I won't be the one fighting for it to be part of our structure. I just don't see it. I think our longer term, I'm sure. Like, it's not my knowledge base. And when I look at our clients and who I sit across from at lunch, those guys aren't pushing for it either.
Yeah, the world changes with now these the younger generations coming up. I mean, NFTs, I don't even fully get, but there's a crazy world out there for those things. I find myself just looking back, like you watch the Super Bowl halftime show, And when they used to play like all the old rock and roll bands, and you're like, oh, those are for your parents, and now they're playing stuff. Now I realize I'm the older generation, so hard to keep up these days. Well, this has been great, gentlemen. I think we can move forward to see if there's any questions that come out of the market or out of the group, sorry, and yeah, let you guys answer some specific ones. Leah?
Well, I think you guys just covered off one of them. It was about having any thoughts on the metaverse and really digital real estate, and would any of you guys lend on it? I'll throw it back to Matt, Garth, or
yeah, I mean, it's so hard. Like, I don't even.
Do you want to give it a try, or are you done with that?
Supposedly, yeah, you can buy a penthouse or a condo in the metaverse, which is ridiculous. But yeah, I mean, do you guys know anything about that stuff?
Well, being the dinosaur on the call, I will tell you, if I don't understand it, I'm not financing it. So whether it's Bitcoin as payment, it's certainly going to make qualifying a pre-sale difficult. And as far as financing something in the metaverse, I'm not your guy.
Okay.
No, maybe I'll jump in.
HSBC's the World Bank, right? No, it can't. Shouldn't you be doing the meta world too?
Somebody above my pay grade may change their view, and I do think, to be fair, I think it's inevitable that it's coming. I mean, I think at some point it is inevitable. I think at this stage, though, and with my lack of understanding of it as a concept, yeah, I won't be the guy.
That's fair. Mike, you were saying something.
I was just going to jump in. Like Garth kind of stole my thunder there. I was going to say, when and how, are two questions that I have. I don't know that we'll ever lend on anything in the metaverse, but I do know that there's a lot of room to improve with how we process a loan within our financial institutions and how we understand those risks. And I don't know what the outcome is, but I think if we look back on this question 10 years from now, we'll probably see some pretty significant improvement. So will CMLS be the first? Maybe. Probably not, but maybe. But I think there's some pretty significant efficiencies that can come out of our business from some of the technology that's out there.
Agreed. All right, I'm going to put this question out to the three of you, and whoever wants to answer, just jump in. How much stress testing is being done by your group on prime rate as it increases? Is it?
A fair amount.
Yeah.
A fair amount. I think it's, a combination of stress testing. We've always done it. I mean, this is not a new concept. I think, right now it's on rate, but we've always assessed our exposure against valuation fluctuations or absorption, shifts in absorption. So stress testing as a lender, it seems to come with the job description. I think with rates, it's harder to really assess, to be honest. If rates go up, because it's going to impact the consumer. It's easier on the IPP part of our book, but on the construction side, it's a bit more of a challenge. But stress testing as a concept, frankly, is as old as banking.
All right. Anyone else want to jump in?
Yeah, I think we're in the same boat. I think our risk analysis has always included sensitivity analysis, and we continue to do that. And our risk group is probably keeping a little closer eye on how we're looking at interest rates. But yeah, it's always something we've done.
Sounds good. Well, we're at 1 p.m. and the only other questions I have here is regarding Derek's mustache, which doesn't apply to real estate. So
yes, it's real.
I will thank you guys very, very much for being on the panel today and all your insight that you've provided. From the MIABC, thank you, and have a great day.